Hello, and thank you for joining us. We are going to present to you the Berria Txapela franchise and why you should invest in it. This is everything we're going to cover in the presentation. We are thrilled to introduce to you Berria Txapela, a new bar franchise set to open on July 1st, 2025, on the iconic San Sebastian beach in Barcelona. It was created by a well-known Basque chef with a successful restaurant portfolio. Berria Txapela combines prime location and brand appeal to capture beachgoers and locals alike. We are looking for a 300,000 euro investment, with projections showing strong returns over the next 4 years. The investment structure minimizes upfront capital. One third or 100,000 euros is required by June 30, 2025, and the remaining 200,000 euros by June 30, 2026. Additionally, our depreciation schedule spreads over 8 years and provides sustained tax benefits, enhancing profitability.
Let's dive into our revenue projections. We expect the first year sales to reach 600,000 euros, with a 2% growth each year driven by the site's strategic location and strong brand visibility. Cost of goods sold starts at 32% of sales, but will gradually improve to 30% over time, thanks to efficiencies gained as we scale. This improvement directly supports our gross margins, maximizing profitability from the start. Operating expenses have been strategically managed. Personnel costs are set at 25% of sales, ensuring the team is well staffed without overextending costs. Franchise royalties, fixed at 8%, provide a predictable expense structure. With stable cost and growing sales, our earnings before interest and taxes is forecasted to grow from 162,500 euros in year one to 168,512 euros by year four, reflecting a profitable and scalable model. Now, looking at the balance sheet, equity is projected to grow constantly, reaching nearly 500,000 euros by year four. This strong equity position provides a buffer against market fluctuations, enhancing investment security. Regarding operating net working capital, we expect a slight decrease from 8,000 euros in year one to 7,959 euros in year four. This small change reflects effective working capital management, ensuring we maintain liquidity and operational efficiency. Overall, our focus on both equity and operating net working capital reinforces investor confidence in our ability to navigate market dynamics.
So we'll now analyze the free cash flow to the firm, which represents the cash available to both debt and equity holders after accounting for all operating expenses, taxes, and the necessary reinvestments in the business. So firstly, for year zero, we can see that the free cash flow to the firm is equal to minus 100,000 euros. That is reflecting the CapEx. And for the years 1, 2, 3, and 4, we will calculate the free cash flow to the firm in two different steps. First of all, we calculate the operating cash flow, starting with the earnings before interest after taxes, and we add back the depreciation expense as it is a non-cash expense, so for each year, and obtaining the operating cash flows. Then we will deduct the CapEx and the net working capital changes to finally obtain the free cash flow to the firm for each single year, which will help us to determine the financial health of the company and the cash generation of this company. So now, after having calculated the free cash flow to the firm for each year, we have decided to plot the free cash flow to the firm line and the accumulated free cash flow to the firm line on this graph to visualize the free cash flow trajectory. So first of all, the free cash flow is projected to grow steadily from minus 104,750 in year one to 117,802 in year four. So this actually reflects strong cash generation for this investment due to increasing sales and improving cost efficiency. Then the accumulated cash flow actually becomes positive by the end of year two and beginning of year three, and strengthens significantly in year three and year four, which demonstrates robust liquidity.
Moving on, my name is Mark, and I'll be discussing now Berria Txapela's working capital requirements, financial scenarios, and lastly, their project valuation. Starting with working capital, Berria Txapela operates efficiently with clients paying in cash and inventory managed to avoid overstocking. This keeps the cash conversion cycle very healthy as inventory is held for as much as 30 days, while suppliers only provide a 15-day credit period. Over the 4-year forecast, working capital requirements grow modestly alongside sales, from 7,650 in year 2 to 7,959 in year 4, maintaining liquidity without tying up excess cash. Now, looking at financial scenarios, we analyzed the impact of different WACC rates. At 10% WACC, the net present value is 877,885. But as WACC rises to 18%, the net present value decreases to 367,145, showing sensitivity to financing costs. The internal rate of return is stable, of course, at 46.92%, assuming perpetuity across all the scenarios. But the modified internal rate of return, which accounts for reinvestment, increases with WACC, reaching 20.58% at 18% WACC. This suggests that the modified internal rate of return, rather than the internal rate of return, gives a more practical view of Berria Txapela's return potential, especially under high financing costs. Finally, we used a DCF model for valuation. The total net present value, including terminal value, comes to 684,845, with cash flows turning positive by year 1 and reaching 117,802 by year 4. The high internal rate of return of 46.92% compared to a 12% WACC indicates that Berria Txapela's returns far exceed its cost of capital, underscoring strong investment potential.
So finally, coming to the end of our presentation, we want to once again wrap up why this is a very appealing investment for you. First of all, given the data that we have, we're able to construct a forecast and more specifically a forecast of cash flows that gave us a total net present value of 684,845 euros. This relates to the idea that our project is able to generate significant cash flows in the future, both in the short and in the long term, being on the line with a terminal value at the beginning of period 5 of 982,986 euros. Using other methods to evaluate the project, we also used the internal rate of return and the modified internal rate of return, both approximated for a period of 50 years of cash flows. And both of these methods, in fact, both of these returns gave us a return higher than the weighted average cost of capital of 12%. We're also, once again, underlining that the project is able to generate high yearly returns relative to the risk associated. Last but not least, we also used the payback method to evaluate the project. And here we got a period of 2 years and 263 days. So also for you, this would be very interesting because this will tell you that you, given your initial investment, you would be able to recover your investment relatively soon in this period that I just mentioned. So coming specifically to what is our proposal is that we are willing to offer you an equity or a share of our equity corresponding to 44% of our company for an investment of 300,000. How did we get these values? So using the net present value, we basically found that our current company valuation, given the cash flows in the next periods discounted, our current company valuation should be 684,845 euros. Considering that we are seeking an investment of 300,000 euros, this would relate to 44% of our company. Considering that we split our company into 100 shares, we are specifically offering you 44 of these shares for a price of 6,844 euros per share, and a total price of 300,000. We hope that we were able to convince you with our presentation. And more specifically, we hope that we were able to convince you to invest in our company. and we're looking forward to hear back from you soon.